from around $500 in the 1950s to over $5,500 today. That's an average of 10.26% per annum over the last 7 decades. Tell me any other investment asset that has come close to this track record. Spoilers alert, there is none. The S&P 500 or Standard & Poor's 500 is like a report card for the market that tells you how well the stocks are doing overall. It first debuted in year 1957, tracking 500 of the largest companies in the New York Stock Exchange, NYSE, and also NASDAQ stock market. And today, it is known worldwide as the benchmark index, with a market capitalization of more than $46 trillion, covering 80% of the total US stock market's value. The index includes 11 sectors such as IT, financials, and healthcare, etc., which provides a lot of diversification, and hence why it is an all-time favorite by many long-term investors, since it balances out volatility while providing superb return over the long run.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin.
For decades, the S&P 500 has proven itself time to time as one of the most popular investment index, even after going through various crashes and crises. From around $500 in the 1950s to over $5,500 today, that's an average of 10.26% per annum over the last 7 decades. Tell me any other investment asset that has come close to this track record. Spoilers alert, there is none. But of course, the S&P 500 isn't always green. There are some years with negative returns as well. During the 1981 to 1982 recession, the S&P 500 declined approximately 27% in just 20 months, resulting in a negative return of 9.73% in the year 1981. And this is due to the high oil prices, making everything so expensive, so much so that the Federal Reserve had to step in to raise the interest rate to 19% to reduce inflation of the prices. But fortunate enough, the inflation started to slow down, and that resulted in another bull market from 1982 to year 2000, until the infamous .com bubble that sent the S&P 500 falling nearly 50% over 3 years from year 2000 to 2002. And the returns, well, don't look good at all. And fast forward to 6 years later, the S&P 500 saw another huge 57% decline, which resulted in a negative 38.5% return, the worst since the 1930s Great Depression.
Soaring gas prices, falling home prices, and rising unemployment.
Lehman Brothers is going bankrupt. The closing bell at the New York Stock Exchange, the main index, down over 7%.
However, of course, the rich become richer if they buy the dip, because the index then went on a bull market run for about 10 years later with more than 300% gained. However, of course, good things don't last forever. When the COVID-19 pandemic hit back in 2020, the S&P 500 crashed by 34%, but it quickly recovered and reached a new all-time high at around $4,700 at the end of 2021, growing more than 100% when the Federal Reserve decided to cut the interest rate to 0% rapidly, which then increased the supply of money that helped businesses and also individuals to pull through the pandemic. But of course, the interest rate cannot remain zero for too long, as this will cause high inflation of prices as too much money then flows into the market. So the Federal Reserve did the exact opposite. They increased the interest rate rapidly from 0% to 5.5% within just a span of 16 months, which caused the S&P 500 to decline by 19% again in 2022. And I'm sure many of you that have invested back then will be able to relate to me. It was a bloodbath for a lot of growth stocks. Now, from the low in 2022, the S&P 500 has rallied up more than 50% today with the emergence of AI technology like ChatGPT, which then spurred the growth of the entire AI industry. And that led the entire vertical of the semiconductor chain to shoot up, especially leaders like Nvidia, AMD, TSMC, ASML, and so many more. Is this an indication of an AI bubble? Well, all I can say is that there are strong signals that the Fed is going to cut interest rates very soon. So this bull run may just last for a few more years. Only time will tell. Oh, by the way, do you know that you can easily check the S&P 500 index return with just a finger's press? How? By using the Moomoo app, the sponsor for today's video. In the Moomoo app, on the first page itself, you can get live updates of all the US indexes like the S&P 500 and etc. and get access to real-time price changes of all its constituent US stocks for free. And you can check the ETFs that track the S&P 500, compare their Morningstar ratings, and also look at all their annualized returns. And most importantly, the overview that shows the ETF's details, such as the expense ratio and also their management fees, which I find the most useful in deciding which ETFs to invest in. You can now invest with Moomoo Malaysia at a super low cost of 3 ringgit per order in Bursa Malaysia, and also only 99 US cents per trade in the US stock market. Plus, you get a whole lot of useful features like the economic and also earnings calendar, my favorite, stock screener, and also live news from reputable sources like Bloomberg, Benzinga, and Barron's that are all free for a lifetime as well. And before we head back to the video, I just want to share with you that Moomoo Malaysia is running a limited time campaign where you get a 100 ringgit cash reward when you deposit 1000 ringgit. And if you use my exclusive link down below to sign up, you can get an extra 40 ringgit cash reward as well. And on top of that, you get an extra free 400 ringgit cash when you deposit 10,000 ringgit and a free guaranteed Nvidia shares worth around 560 ringgit by just depositing 30,000 ringgit and buying 3 trades, which gives you around 3.7% return immediately. Or, this is the best part, or about 44% annualized return. So quickly before the promotion ends. Now, back to the topic of the AI boom. Did you know that super microcomputer SMCI recently joined the S&P 500 after the stock increased massively at over 200% within just 3 months, more than doubling its market cap to $46 billion today. So now it probes the question of how a company is added to the S&P 500 index. What's the requirement to enter and who decides that? Remember how Tesla struggled to enter the S&P 500 index in late 2020 even after being profitable for a while? Yeah, just like the Oscars, the components of the S&P 500 are selected by an index committee. Essentially, there are a few basic requirements. 1. A market cap that qualifies as large cap, and according to their official guideline, which changes over time, it is defined as a market cap of at least $18 billion. And 2. The company's shares are sufficiently liquid, where they at least have 250,000 of their shares traded in each of the previous 6 months. And 3. Their shares are mostly in the public's hands so that it helps to remain the integrity and also the stability of the index itself by reducing the risk of manipulation by insiders. And number 4, they have an initial public offering IPO of at least 1 year earlier. And lastly, number 5, a positive sum of the most recent 4 consecutive quarters of earnings, including the latest quarter. But Zed, why does this matter to me? This is precisely why S&P 500 is one of the longest standing and above average performance for the last 7 decades. It's called the self-cleansing mechanism. To make it simple for you, they simply kick out the losers that don't perform over time and then include incoming winners. It's as simple as that, and hence, like I said earlier in this video, it is one of the most popular and, dare I say, reliable passive investment index that investors worldwide will opt for. And just to give you a better idea, a study by McKinsey shows that the average lifespan of companies listed in the S&P 500 was 61 years in 1958. Today, it is less than 18 years, and they believe that in 2027, 75% of the companies currently quoted on the S&P 500 will then be disappeared. And that's exactly why when we look back at the top 10 holdings of the index, it is ever changing. From IBM as the big boss in the 1980s and 1990s to General Electric, a big automotive brand back then in the 2000s, and then to ExxonMobil, an energy company in the 2010s, and now Microsoft as the big boss today. And by the way, only less than 25% of you are subscribed to the channel, so if you want more videos like this in the future, please consider subscribing and let's get to 100,000 subs together. Thank you. Anyways, there's something else that no one will ever tell you, but it's very crucial to know why S&P 500 is so unique as compared to every index out there. And this is because it moves based on the market capitalization weighted method, which means that companies with larger market values have a bigger impact on the index performance. For example, we have 3 companies in a simplified version of the S&P 500 over here. Company A has a market cap of $100 million, Company B at $200 million, and then Company C at $300 million. So altogether, the market cap is about $600 million. This means that Company A has the lowest weightage at 16.7%, B has 33.3%, while C has the highest at 50%. But then, when the stock price of Company A increases and say its market cap grows to, let's say, $500 million, and Company B and C's market cap doesn't really change, Company A now holds the biggest weightage at 50%. Why does this matter? Well, just see how this index compares with its equal weight S&P 500 peer, which weighs each company equally in the index regardless of its market cap. You can see that it has consistently beaten it over different time returns, and that just shows the beauty and strength of how this index moves as a whole. Anyways, if you intend to invest in the S&P 500, you can do it through a regulated investment vehicle called the Exchange Traded Funds, ETFs. They are essentially tracking the indexes, such as my favorite, Vanguard S&P 500 ETF with the ticker symbol VOO, or others like SPLG, IVV, and also SPY ETF. No idea what I've just mumbled? No worries, I've made a full video comparing all of them before, so go ahead and explore them. See you over there.